some dealers like us who have clients who are trying to liquidate large positions all at once are calling on their wholesalers, calling on the refineries to help move that metal for the capital required to make the purchases from their clients. And essentially that capital started to dry up. Like you said, people are tapped. There's only so much money in the system. And then what the wholesalers did to react is they dropped their bids by $10 an ounce on silver, which is basically 10% at the time. So what they're saying is, we don't want your silver. We don't want to buy your silver from you guys right now. That lasted about 48 hours before the price dropped to $80 an ounce, which created more buyers. Again, it shifted the ratio back. So to answer your question, when everyone is trying to liquidate at the same time, the supply chain will break. So if you're a smart investor, have an exit strategy, and you may want to think about selling a little bit before the curve. So if you're like, hey, I'm happy at $90 an ounce, 9,500, you may want to liquidate a small percentage of your portfolio.
Okay, and let's reverse this entire scenario. What do you think happens? Where have you seen moments where demand overwhelms supply, and what implications would that have?
Similar, 2008 financial crisis was that scenario. By about 2010, demand was just massive. And working at Kitco at the time, the only two products we had left in stock were 400-ounce gold bars, which not for everybody, and 1,000-ounce silver bars, also not for everybody, especially when silver had run up to $48 an ounce or whatever it became. So if you have a market where it's only demand and there's not a ton of secondary market product flowing back in, you're going to end up with product shortages.
I'm your host, Farzin Irani. Let's connect the dots. If you're interested in the discounts being offered by Strategic Wealth Preservation, please look below in the show notes. Over the past few years, we've watched inflation surge, central banks buy record amounts of gold, geopolitical tensions escalate, and trust in financial systems quietly erode. At the same time, more investors are asking a very simple question. Do I actually own what I think I own? Today, we're connecting the dots between markets, geopolitics, physical ownership, and what it really means to protect wealth in uncertain times. I'm joined by Mark Yaxley, Managing Director at Strategic Wealth Preservation, a global precious metals dealer and storage expert who sits at the intersection of investor demand, sovereign behavior, and real-world asset security. Mark, welcome to the show.
Farzin, my pleasure to be with you. Thank you.
It's a pleasure to have you. Could you give our guests and our audience a quick recap of your career so far, and what does SVP do in a short format?
Sure. With regards to precious metals, my career began in 2006. This was prior to the last major financial crisis of the 09-11. I was a 26-year-old growing up in Montreal, Canada, and that happened to be home to one of the largest retail precious metal dealers in the world, which was Kitco.com. You're probably familiar with the website. So I was hired there in my young days and began my journey, which is now in year 21. I've been dealing in precious metals for the last 20 plus years every day. I've touched just about every facet of the business. I began in, client services, moved into marketing, product development. I've touched on the wholesale side, and now obviously running Strategic Wealth Preservation, which is as you said, a global precious metals and storage company. So I've been spending a lot of time around gold and silver the last 20 years.
Great. We will go into more details about what your organization does towards later on in the interview. But let's start with getting our audience the bigger picture of what's happening in the world and what are you seeing in the precious metals market from your perspective. So my first question to you, from your vantage point inside the industry, what has fundamentally changed in investor behavior in the past, say, 12 to 24 months?
That's a very good first question. The fundamental change in investor behavior the last 12 months, I would say there's been an awakening amongst a broader base of investors who, for the most part, historically have avoided the conversation of owning precious metals or had no interest in owning precious metals. And now, in these types of markets, what you end up seeing is people that, they have the fear of missing out. They see it in the headlines. Gold has become a headline item, right? In the newspapers, online. So fundamentally, and we can dive into what that exactly and where the market is moving and shaking, but fundamentally, you're seeing a much broader base of investors coming in. And also with that broader base, that volume of investors, you also see large transactions occurring because you have, single family offices repositioning their portfolios. You have the Wall Street wealth managers who see a greater return in gold and silver this year and therefore allocating more of their clients' money into gold and silver. And then, of course, you have the more loyal, gold bugs, silver bugs, whatever you want to call them, that are always stacking. They're just happy to add to their positions. And of course, the central banks you touched on, they started driving all of this really about 3 years ago. This is not new to the central banks. It's just that the rest of the market is catching up now.
Yeah, yeah. We'll get to the central bank just next. But do you think, just from the perspective you're seeing and the conversations you're having, do you think this is more fear-driven demand or something more structural is changing in the system?
That's another good question. I think it's both. Structurally, the system and the world are changing on a macro level. You have a significant power shift between East and West. You also have a lot of tension in Europe, of course, which is, driven by both sides of that. But I think, the United States, not to pick on them too much, but they're an empire that is perhaps entering the last phase of their dominance, of their global dominance. Very indebted, poor leadership. Not to get political, whether you think Donald Trump is a good leader or not, but they're taking, collectively, they're driving their country, I believe, in the wrong direction. And they're entering a stage of desperation versus, you can look at China and other countries that have a more structured, strategic approach. And the reality is there's a major shift occurring there. That creates fear and tension amongst the rest of us. Those macro vibrations that are happening in the world, we all feel it as individuals in our own personal lives. Many of us can't explain it. We just know that something is changing because the vibe on the street is different, and it's complicated to understand all these things. And I'm not going to pretend that I can explain it to your audience, but I think more and more people feel that something is changing. They feel fear and they feel this volatility in their lives and in their investment in their portfolios, particularly. And therefore, precious metals comes back into the conversation more regularly than it did 5 years ago.
Totally agree. I saw a clip about a couple of months back, just towards the end of last year, where in Australia, there was a long line outside a precious metals dealer where people were lining up all day on a Saturday, I think, just to get their hands on the physical gold. And that, I would say, is, again, whether it's a structural shift or fear-driven, I think some people are waking up and saying, my dollar, whether it's the Aussie dollar, the Canadian, or the US dollar, is being debased. And I'm just not saving. I'm running on a treadmill and I just can't get ahead. So maybe gold is the way. And I think platforms like mine, and there's a lot of education going on right now as well, where people are actually understanding what gold and silver is and what fiat currency is. I think Bitcoin had a lot to do with that, to wake a certain part of the audience up just to understand fiat currency, I think. And that is what has got people into anything else you'd want to add to that?
Well, I think you're bringing up a very valid point that does affect everyone, as well as is inflation and the effects of inflation since, let's call it, since COVID. I mean, it's not like an inflation is a new thing. And, our parents probably suffered it, in the early 80s, late 70s, early 80s. They lived through high inflation periods. This is really the first time of high inflation that maybe our generation is experiencing. And that is way out of proportion due to COVID and just insane government spending during that period of time, which has taken a few years to really work its way through the system. And then how that ties into, so that affects everyone. You cannot ignore it. You go to the grocery store, you go to the gas station, wherever you are, localized pricing is affected. But how that ties into precious metals, obviously commodity, it's based on, US dollars. So it's pegged to the USD, or it's priced in USD. So it's going to hedge naturally as inflation rises. And generally what you see with gold is that gold over a long period of time appreciates at a value of approximately 8% per year, which is probably what real inflation is extended over a longer period of time. Right now, inflation is higher than that. So yeah, very good point. I'm glad you raised it, because that's one thing, aside from the fear and aside from the macro changes, the inflation is a very real thing that we're feeling every day, and a great reason to be owning gold at this point in time.
Yeah, thanks. And obviously, you said inflation, right? It's not an act of God. It's actually a policy pursued by the central bank, also based on directions by the government. So let's come back to the central banks and sovereign signals, so to speak. We are seeing record central bank gold purchases. Obviously, that had to do with the US freezing the Russian assets, and most central banks heard that gunshot around the world. What does that tell you about how governments themselves view currency risk and global stability in a way?
I think actions speak louder than words, and central banks accumulating physical gold as part of their reserves, and it's not only a part of their treasury. Like a company might accumulate gold as part of their treasury. This is a bargaining chip, essentially, for governments when they go to the table, when things are getting to the point where they feel that there's going to be global conflict. For example, we saw this during the Second World War. The countries that had the most gold were able to negotiate a better position and a better outcome for themselves than countries that didn't hold gold, for example, or had very little gold, couldn't pay their debt, so on and so forth. So, you look at Poland, for example, challenging position for them, bordering with Russia, knowing that there's a real threat there, have been accumulating gold very aggressively and have become one of the larger now holders in Europe of gold. So the actions speak very loudly. I think it's a very clear signal that those, and you can you hear a lot of retail investors criticizing central bankers. Oh, they're equal. They're up to no good. They're out to get us. And maybe it's true. I don't know. I'm not privy to those conversations, but what I do know is they employ very smart people, and those very smart people have a plan and have been accumulating. So again, yeah, it sends a very clear signal. And that signal was really started around COVID. Yes, great point. When the US started to sanction Russia and really put tighter controls on them, that was a very clear signal, like, hey, the rules are changing. We can, we can leverage sanctions very aggressively. And they continue to do that today. They're leaning into that tactic again, which they've done for a long time. But the point being that that gold obviously gives countries another means to settle with one another, and another means to have a strategic advantage when needed. So
Yeah, there was something great you said in there. It didn't just start there. It was actually COVID. And if I'm being honest, China actually started dumping US treasuries and buying gold after the global financial crisis. Some of the smaller countries, maybe who were scared of what America would do, after the Russian incident, they got a green light saying, okay, so you've proved it that you are not reliable enough, or we can't trust you. And then I think the floodgates open with the central banks just openly and honestly going, we just need more gold. That was that trigger where they could openly do it. And that's where we go into geopolitics as well, right? Which with these conflicts expanding and global alliances shifting, how does the fragmentation maybe affect the metals demand? We've discussed it, but because you have multiple locations, from that point of view, we won't go into exactly what the locations are if you don't want to right now. But do you think it's becoming less about inflation and more about trust? Based on which countries you can trust and which jurisdictions you can trust and stuff like that?
yeah, I mean, so to your point, if you're using gold as a hedge against inflation or a hedge against other asset classes in your portfolio, and you start to accumulate a sizable position, one of the questions, or one of the risks that you face yourself as an investor is, what is the best place to store my gold? Ultimately, it's all priced in US dollars, and then you're going to use your local currency to buy it. But ultimately, it's a commodity, so it's priced in USD at this point in time. But the question becomes, where's the best place to put it? And do I keep it all in one place? So you're talking about geopolitical diversification, or sorry, diversification. That's the concept that you get into. So let's say you're an Australian, you've accumulated, $100,000 worth of gold. You have to start to ask yourself, first of all, do I want to keep this at home any longer? Do I want to keep this on the family property any longer? There's some risk now that if it were to get lost or stolen, it's a substantial amount of money. So you might start looking at vaulting. Then you would say, do I want to put it in a vault in this jurisdiction? Do I feel confident that my government and their oversight and the reporting requirements of this jurisdiction are not too severe that essentially I'm going to put it in a vault and they're going to know what I own? That's not usually what gold and silver investors are looking for. So you start looking at jurisdictions where privacy laws are a little bit stronger, perhaps, or reporting requirements to foreign governments are non-existent. And then you start looking at the likes of Singapore or Switzerland or the Cayman Islands, these offshore jurisdictions that specialize in financial services and understand that investors are looking for a certain degree of privacy. And then you can start spreading your risk and being strategic about where you place your gold and silver.
Yeah, you're absolutely right. People are concerned about this, especially after COVID and with the amount of digital ID laws that are being brought up. You gave a great example in Australia as well. I have clients in New Zealand and Australia, and people are concerned, especially because Australia is talking about unrealized capital gains taxes and all of that. And they want to tax a spare bedroom in your house if you're not using it. It's getting crazy. So obviously the next point is they might come for your gold or silver. And I think you're Canadian. You also have seen an example during the truckers' protest. And what happened there?
I mean, I was having this conversation with a friend this week over lunch. We were talking about government, and I'm not a political person because my view of government in general, and I'll use Canada as an example because I know it best. I still live part of the year in Canada and I grew up there. Government is much too present in our everyday lives, in my opinion, especially in developed G7 countries or G20s. They tend to overstep completely. They tend not only to provide us roads and hospitals and all those things, which they tax us heavily for. So we're overpaying for all these services to begin with because they're totally inefficient as opposed to a private company. Because ultimately it's not their money. So that, the overspend is not nearly possible as if you're a shareholder of a company, for example. So there's that aspect of taxation, which we all feel. But the other aspect is the influence in our day-to-day lives, where basically they have become this moral compass for a lot of people. They tell us how we should live, what that should look like. They decide all these very important policies that affect all of our lives on a regular basis. And most of us either don't pay attention to the policies or, and maybe we should, there's an argument to be made, but don't really realize that all these decisions that impact our day-to-day lives are being made by a fairly small group of people. And yes, the argument is we're elected. It's a democratic country. But do they really have our best interest in mind? And so my position personally is I try to distance myself from reliance on government as much as possible. I say my family will never need a dollar from the government. I will provide for them. I will save. I don't want the government pension. Yes, I have to contribute. It's the law. But my approach is really do not count on them. And if I had my perfect world, I would say much smaller government, much leaner government, only essential services. And please stop telling us how we should live our lives. We can figure that out on our own, quite frankly.
Yeah, well said, Matt. This is exactly what I would sound when I get interviewed on a show in New Zealand called Money Talks. Minimum government, we don't need them. But obviously, it's turning into, especially as you said, the G7 and the Western democracies, it is turning into a nanny state. And that is because, as I've mentioned to my viewers on both platforms, there's too much debt. They need to default, and they're finding ways of blaming it on somebody else. And that is why they're trying to bring in the CBDC and the digital ID and all that kind of stuff as well. As you said, you don't want to rely on the government. Imagine in countries like Australia, New Zealand, Canada, where people are relying on the government for healthcare or for superannuation. And I don't think any of these governments in about 10 years' time is going to be able to afford those things for their citizens because the tax bill is coming due. But anyways, let's move. And that is why people like you and I and people we interact with obviously need to become their own central banks or protect their own wealth and preserve their own wealth for the future generations, right? That's why I brought you on, right? Because you could actually discuss this from your strategic viewpoint as well. And that gives a totally different twist to the conversations that we have with macroeconomists and all of that. Now, because we're talking gold, I want you to educate people on the difference of why physical gold versus paper gold, hand, like gold literally in your hand, and what are the other options? I know there's ETFs and futures and all of that. So do you want to talk around that, please?
Yeah, it's I'll try to keep it to the basic principles of why physical gold. And first to say, I'm not here to say that there's no reason not to purchase an ETF or there's no reason not to buy mining shares. There are great opportunities and reasons why you may use those investment vehicles at certain times. For example, an ETF, if your window or your horizon, if you say, hey, I've got $100,000 to invest for the next 3 months, we find ourselves in a good precious metals market. Should I buy physical versus an ETF? Honestly, I'd say probably buy the ETF. You're going to save a little bit on the premiums in and out of the transaction. You know that your time horizon is limited. You need a quick and convenient, cheap way to enter and exit the market. That's why most investment managers, wealth managers, will use it as a vehicle for their clients. The mining stocks, you can knock it out of the park. If you know how to analyze a mining company, and you're willing to take some risk, you can really make a great return. The problem is 9 out of 10 times you won't knock it out of the park because you don't understand how to analyze the company, or you followed a newsletter writer who got it wrong. And unfortunately, there's a lot of money to be lost. I've heard that said firsthand by people that study these companies in Canada, which is a huge market for mining.
And on that, I just want to add, especially with now with the inflation and the geopolitical risk, if you don't, and the jurisdiction risk of different countries, what we're seeing with Venezuela and stuff, I think that just added a 10x risk factor to any mining stock if you don't know what you're doing, right?
Yeah, and I think people, I'm not saying everyone, there are some that understand the space extremely well, but general public, they think I'm buying a mining stock, I'm buying exposure to gold. You're not buying exposure to gold. You're buying exposure to risk associated to one particular company. As you pointed out, if that company, there's a nationalization event, there's some change of political figures in that country, there are all kinds of risks that can affect a company at any given time. And so, yeah, you're not, you're not taking the ride with gold, you're taking the ride with that company. So it's a very different argument, different conversation. But physical gold, it all boils down to there's two really major points. Counterparty risk. So by owning physical gold, you are eliminating counterparty risk dramatically. Now, if you store it in a vault, yes, there is another party that you're contracting with, and that's important that you understand that relationship and the contract and so on. But if you buy a 1 ounce gold coin from your local dealer and bring it home to your house and you stash it away, zero counterparty risk. That is your second point, personal property. Personal property is a very important thing in the law because it carries very strong protection for the holder of that property. Property laws are like the most basic thing in law, essentially. When you are an owner of something, you have very strong rights. There's nobody else that can come and take it from you. There's no counterparty risk that exists. Government, even in the most westernized developed countries where government thinks, like you said, all these digital IDs, all these ways that they keep track of us, all your information in your bank about your bank accounts being shared, your pension, so on and so forth. That doesn't exist, and they have no right to your personal property. So very, very important that you understand when you own physical metal, it's like owning a watch, it's like owning a car, it's like owning your home. You have a very strong title to that. So I'd say that's the biggest argument for owning it. And some people will say, well, you know what? I can, own an ETF, or I can own unallocated gold, which is a very popular, means as well. I can own paper gold, for example, and I'm going to save like some money doing that. And it's like, yeah, but how much are you going to save? You're going to end up saving, call it 2% over the lifetime of the investment. And you're willing to trade 2% on the lifetime of an investment and introduce counterparty risk and all those other factors into it. Like, that's not logical. I'm sorry. So if your horizon is 5, 10, 20 generational, there's no reason to risk everything for 2%.
If this conversation resonates, it usually means you're already sensing that the world of money is changing faster than the advice most people are getting. These conversations are really about helping people think more clearly. Not predictions, not hype, just understanding how the system actually works. So, this episode helped connect a few dots for you. Liking the video, subscribing to the channel, or sharing it helps these ideas reach others who are asking the same questions quietly. That's how we grow together, one thoughtful conversation at a time. Thank you. And I can give you a very good example of the unallocated gold. I came across a story about the Perth Mint, I think about a year and a half, 2 years back. I don't know, I can't remember all the exact details, but there was a lady in Sydney who thought she owned a certain amount of gold and silver in the Perth Mint. Even though it was unallocated, it is supposed to still be, this is your gold inside with all of these other people's gold. And I think it went on for about 3.5 months before she got about 20% of it. So that tells you that they actually don't put it aside. Allocated, unallocated, totally different things. Again, there's so many small nuances to this, and this is where people don't sometimes get it. They just think, oh, it's just gold. It's an investment linked to gold. That is why I got you, because you can actually talk about these different factions from your point of view as well, and the storage point of view as well. Can you differentiate between why would someone hold it at home as compared to hold it in a vault as compared to hold it in a secure facility elsewhere?
Yeah, for sure. And just to close the thought on unallocated, because it is such an important point that people don't understand the allocated versus unallocated, right? But the unallocated, to your point, the Perth Mint, which is a big name, but there's others. And I've lived through this firsthand working for other companies. If you read the fine print of what unallocated is in a storage agreement, essentially they're saying we as a company hold a position of gold of ounces, and we promise you that your portfolio or your amount of gold is held within our gross amount of precious metals. But how that precious metals that they're holding is measured is completely up to them. So it could be a paper position that they own. So it's just hedged. They've hedged it with, a firm on margin. They've sent off a lot of gold to be recycled at the mint. It's in transit right now. It's going to take 6 months, 6 weeks. Let's not exaggerate. 6 weeks to be processed and paid out. They'll have a small amount of physical backing that. It probably, I would guess, 10-20% of the position at most, because it's not cost effective for the company to run that program in that way. So essentially, you have no idea what you're actually holding. They know, they have on their books and their ledger what it is, but where it is exactly, to your point, the Perth Mint probably got caught in a position where they were asked to pony up not only her gold, but a number of people's gold, because then it probably leaked and there's a little bit of a run, and then there's a shortage on gold. So, again, it's really, really important. Now, in terms of storage options, a lot of people start at home. I always say, if you're new to the market, going to your local person and buying physical gold or silver from your local dealer is not a bad place to start. You can have a lengthy conversation, a cup of coffee. You'll walk out with the physical metal in your hand that very day. You can bring it home. You can look at it, put it away in the closet. Great place to start. The problem becomes, especially with the prices being where they are today, silver going up 4x, 3x, 4x in the last year. That 100-ounce silver bar that you had in your closet for a number of years that you felt okay about, all of a sudden you're like, well, I don't want that to go missing. So then you think, do I go down to the bank, rent a safe deposit box, put it in there? It's a safer place. It's locked. It's a bank. They're pretty trustworthy people. True. All these things are true. However, the bank doesn't provide you with any insurance. There's also a number of stories that, these are real events that happened. Safe deposit box bank employees that are not necessarily stealing, but they're assigned to work on the safe deposit boxes. Things go missing. Boxes get mistakenly emptied, or, things get given to. Then you have the FBI in California that raided a safe deposit box. I mean, there's the stories go on, and not to just create fear, but that's an option. But again, the biggest, most important point there is they're not insured. So if you're going to take your $100,000 down to the bank, put it in a safe deposit box, if something does go wrong, you're getting zero, just so you're clear. Read the contract, but the bank will not insure that gold, guaranteed. So then you go into private storage, and that's the Brinks, the Loomis, the Malka, the SWPs. They're, we're not the only operator out there. We happen to be more retail centric, so we built our business around retail investors, whereas Brinks and Loomis are more an institutional level facilities. And yeah, we basically, our business is simple. We build a very sound and secure building. We store everything on an allocated, segregated basis. So your silver bar that you bought from, whether it be from us or from someone else, that we now you've passed that control over to, we put it in a box in your name, sealed, and that bar will remain your bar for the rest of your days. It will never be interchanged or used or moved or anything like that. It just sits there, literally collecting dust, which is sounds kind of boring, but it's actually the best thing you could do. And you can then sell that metal back to us later on. So you have the ability to buy, store, and sell. And that's the whole life cycle that you want, essentially. And it's insured 100%. So if anything ever does happen, you're covered and the bar would be replaced. So different options, and it really depends how much you have a lot of the time.
A few good points in there. Obviously, as you said, the difference, I can give you a couple of stories. Traveling to India a bit recently, and out here, the government is constantly changing rules on what you can hold in a bank vault and what you can't. There's limits on cash that you can keep in there, and Indians hold a lot of gold, obviously. And the government's come out and changed some rules around that, saying if there's too much of it, it can be confiscated. If the bank gets robbed, they're not responsible for it. But again, there's something you said in there, right? I think the Perth unallocated is just like banks. It's fractional reserve gold holding. They just don't hold it. Whereas I know, because of my dealings with you and other storage vaulting facilities, if it's your bar, it has a serial number on it, and that serial number stays exactly the same as compared to when somebody goes, if it's unallocated, or that serial number is moved out, and the next one in the future will be yours. And that's the big difference, is your asset, and it just sits getting dust, as you said, because it's just locked away in a place. Now, you want to just tell us about, obviously you mentioned this, but your vaulting facilities also, you're in different countries, different places. Do you want to tell us what jurisdictions do you have vaults in at the moment? And obviously you can serve clients all over the world, right?
Yeah, absolutely. Definitely touch on that just to close the point on, because you're coming back when you talk about the allocated versus unallocated, you're coming back to the central reason for owning physical gold. When you buy gold, whether you're looking at the Perth Mint unallocated program, and there's many others out there, not to throw Perth under the bus, pretty nice people, good organization generally, but you have the option of buying physical gold and storing it in a place like SWP. It comes back to the personal property. Always remember that base rule. That's the foundational item right there. When you're buying unallocated, you're not receiving personal property. When you're buying physical allocated segregated gold, it's your personal property. It's not even on the books of the storage company, right? So that asset does not belong to the company. In the case of Perth and unallocated, I bet you if you read that contract, it's on their balance sheet and they're going to use it however they please. That's why it's so cheap. That's how they get you in. They're like, we're going to give you very, very cheap access to gold, but you're trading up your risk. So to answer your question, storage locations. Our head office is in Grand Cayman in the Cayman Islands, which is a very unique jurisdiction based around financial services, home to the largest number of hedge funds in the world. A lot of money flows through Grand Cayman. A lot of corporations have a presence here. But gold and silver, we're actually the only vault operators on the island. We opened that vault in 2015. And we also offer 14 other locations spread across different jurisdictions around the world. So the United States, Canada, the UK, Switzerland, Singapore. We recently added Dubai, which we're very excited about because there's a lot of gold trading obviously happening there and a lot of wealth moving to Dubai, and New Zealand. So we picked these places because of their different traits, but they all share some commonalities, man. Generally secure. The facilities are very secure that we work with in those other jurisdictions. You've got stable government. Generally, speaking, the U.S. and Canada is arguable, but that's for our clients who want to hold gold and silver domestically closer to their homes, not necessarily go offshore with it, or they'll have a portion domestically and a portion offshore. So the choices for our clients, are pretty much spread across the globe, and they have the opportunity to diversify under the one world, one account, which basically means once you open an account with SWP, you have access to all of these different places, and you can move gold and silver from within the different vaults within the network that we offer.
Do you want to go a little bit deeper on that? Obviously, because I'm aware of that. Could you go a little bit more into the details of how can somebody move their gold from, let's say, New Zealand to Canada or Canada to Dubai? Because again, there's a mindset shift with the whole multilateral system coming about, and the Western paper price compared to the actual physical, which is in the Asian markets. Can you go a little bit into detail of how your organization might be able to help move? Or what are the options that clients might have?
Sure. Good point you're making. Flexibility in today's world is critical. Moving money in the banking system is more and more challenging. Compliance and regulation is ever increasing. So what this does, again, going back to the single account, you go through the onboarding process, you're given an account number with SWP. That unlocks all 15 locations for you. So you could buy and store gold or silver in one single location if you choose. You say, I want to keep it close to home, or maybe I put it in Singapore or the Cayman Islands. Yes, you can do that. That's pretty straightforward. You could also buy gold or silver in multiple locations to spread your geopolitical risk. So you might say, I want to go Singapore, Zurich, Cayman Islands. Or to your point, you can actually move between locations. So there's two different ways that you can do that. Let's say you started with your gold in Toronto, Canada, and you want to move it to Dubai. We can either facilitate the physical movement, so we'll arrange the logistics, the shipping of the physical products from Toronto to Dubai. We do all of the export paperwork, all of the import paperwork, commercial invoices, the whole kit. It's fully insured door to door. Or you can do what's called, and this is, I don't know want to say a cheat code essentially, but it is a bit of a cheat code for people. You can do what's called a location swap, where you can sell in Toronto and repurchase in Dubai. So you're basically taking the proceeds of that transaction and then repurchasing an equivalent amount of metal in Dubai. And you've achieved a very significant geographical movement in a matter of 15 minutes. And you've repositioned your family's wealth or your wealth in what you may consider a better jurisdiction, which is something you just can't do in most cases anymore. So that's a really good option for people to know about.
A good point, but would that, if let's say we were taking option two, I'm just thinking out loud, does that have any tax implications? Or the money just stays within SWP account, one word, one account? Or is there any buying, selling tax implications?
The money does reside within the SWP. So the time you pull the trigger on the sale transaction, the initial sale, that money will become available essentially as a credit, which you would then use with the offsetting transaction. And usually they're done at the same time. So there's no market risk. You're selling and you're buying basically on the same spot price. But in terms of what that triggers in your tax residency jurisdiction, that's not an answer, unfortunately, I can give, because the rules are different across all jurisdictions. So you would need to consult with a tax attorney or tax consultant. But what I can tell you that might be part of the answer for your viewers is that SWP is an active non-financial institution. That's our classification. So we don't have any reporting requirements to the local Cayman government, nor to any foreign jurisdictions in terms of your transactions. That's all self-reporting that you'd be doing on your end. And of course, we're not saying you shouldn't do it. You should absolutely do it. But it's up to you and how you determine to report that to your government.
Yeah, because obviously for the investor to get in touch with you guys to understand all of that, plus obviously speak. So on this channel, we don't give personal financial advice anyways. But I just dug into that a little bit more because in countries like Australia and New Zealand, there's no GST on even buying gold or silver as of right now. In the UK and European countries, there is taxes on buying certain things. At least silver, I think, in the UK, if I'm not mistaken. And that is why I'm just asking about certain movements. But anyways, if you want to add something else, otherwise we don't need to go deeper. People can reach out through to you or speak to their tax professionals as well, right?
Absolutely. I mean, as part of what's nice about SWP, and not to boast, but when your account is approved, you're given a designated account representative. That's going to be the same person you speak to all of the time when you're speaking to SWP. So you can have very detailed conversations with them, and they'll give you as much guidance as they can within the guidelines, essentially.
Yeah. Thanks for sharing that. Um, just while we're on the subject of different locations and stuff, are you seeing different behaviors from investors maybe in Asia, the Middle East, Europe, or North America?
Yeah. So macro trends. We're seeing a lot of metal coming from Canada and the United States into Grand Cayman to our head office facility, our flagship facility. We're seeing metal moving from Zurich to Dubai. So there's a well-known trend now that there's money moving out of Europe, out of the UK, out of Europe to Dubai. Has become kind of this new epicenter of generational wealth. Um, in the East, Singapore remains kind of a nice, steady market where a lot of Asian money flows into in terms of gold trading, anyways. So that the no real notable change that we're seeing on the Asian side, but I'd say Zurich to UAE is a big one, and then the United States and Canada to Cayman or offshore in general, because Americans and Canadians, um, I'd say their sense of what's happening in those countries is a bit of panic, especially people that have quite a bit of wealth. As you mentioned in Australia, I think you were saying earlier that they're thinking of taxing unrealized gains. So on similar conversations happening in Canada as well. So people are beginning to try to reposition themselves.
I think that's it. And the whole thing is you got to reposition yourself before the fact, not after the rules have been changed one night when you're sleeping and legislation's been passed on. And the reason I ask that also, obviously, Western, as you said, a lot of rich money, people who have a lot of money in Europe and UK and all of that, they move into Singapore and Dubai. But the average person, do you think Western investors are late to this trend? Because I was raised in India, but I'm a New Zealand citizen who lives in New Zealand, Australia as well. So I can clearly see the two sides and the trends. Indians have been consistently buying and saving in gold. Um, do you think the Western investors are too late to the trend, or is there's still a chance to catch up based on what we go next into maybe price predictions or where we think it could end up the cycle?
Yeah, I mean, yeah, Indian investors obviously are way ahead of the curve culturally. They've been breaking ahead of the curve for a long time. And all the power to them. I mean, I guess that generational bet that they've been making for a long time is paying off handsomely for their families, and that's excellent. Westerners, yeah, I mean, not particularly loyal to precious metals. Estimate right now is about 1%, 1.2% of their investment portfolios are placed in metals, which is far too little. So are they late to the party? Yes. Are they missing the party altogether? In a lot of cases, yes. Is the timing still good? I tell my friends this. I say, you should always have precious metals. So if you don't have any today, you should have some tomorrow. It needs to be part of your portfolio long term. And so there's not a wrong time to start. It's just, yeah, you've missed some excellent buying opportunities. But again, we go back to that earlier statistic. Gold appreciates on average about 8% per year. So if you're 40 years old, and let's say you've got another 40, 50 years of life expectancy before you pass along your generational wealth, that's 40 or 50 years at 8%. That's not a bad investment. So, yeah.
Hi, as you all know, I'm Farzin Irani. After more than 20 years inside banking and finance, what became clear to me is that the biggest financial mistakes aren't product mistakes, they're thinking mistakes. If this conversation resonates, it usually means you're already asking better questions than most people. So if you built wealth, follow the rules, and still feel there's a bigger picture missing, that's exactly the work I do with clients privately. I don't offer generic advice and I don't work with everyone. But if you value clear thinking, a strategic perspective, and calm decision making, you can apply for a private conversation via the link in the show notes below. Thanks for watching. Yeah, of course. And this is what I tell some of my clients, right? Some people think because it's already past 5,000 US dollars, which in New Zealand dollars, it's just past 8,000. Okay. And around the COVID mark, it was around the 3,000 mark. But if somebody bought gold in 2000, they have 10x, 25x their money. So it's not a question of when you bought it. If you were smart enough to know when to buy it and all of that, the whole point is I openly discuss on this channel as well, talking about geopolitics and macro. If you know governments are going to default or they're in too much debt and they're going to hyperinflate, and if you think we're going to wars, which is going to cause more inflation, the common sense, the question shouldn't be, should I buy it? The question is, how much can I do? Can I save in gold and how much can I buy now before it gets a bit too late, right? Because the table's about to be kicked off. And I've heard, I've interviewed Rick Rule on this channel also, who said he's brought up something in some of his other conversations is the average portfolio size gold in an average portfolio. I think the average was about 3 or 3.5 or 4%, and in the Western countries, it's only sitting just under 1 at the moment. And as you highlighted as well, so even if it doubles or triples from here, not people like you and I buying, but wealth funds, sovereign wealth funds, or Australia superannuation funds have to diversify, and it doubles or triples. Even if it goes from 1 to 2 or 3%, it still doubles or triples, right? From here.
Absolutely. And yeah, so to ride the or pull on that thread a little bit, the 1.2% is a global number. So yeah, Western under 1%, then you've got Europe and East over, probably varying between 2 to 3%. During the 08-11 crisis, that number, that 1.2 global number, that global allocation actually rose to 2%. So it nearly doubled. So there is more room in this market potentially for that allocation to go higher and significantly higher. I mean, nearly double or 80%. So that's that'll be a pretty dramatic price increase. But if you just go back to the basic pricing predictions that we're hearing right now in the market, all of the major banks are releasing their predictions, and I'd say the average is right now about 56 to 5,800 for the year, which is actually very healthy because we don't want to see 8,000 US dollar gold this year. That means something's broken. The supply chain will break. We had a very close call 2 weeks ago where the bids dropped dramatically. The refineries are like, we don't want any more metal. There's too much metal coming back into the market. The price is too high, too fast. It's not a healthy market. So you want that incremental growth. And so 5,600 for the year I'd be very satisfied with that.
Yeah. The liquidity thing you brought up, I heard from, okay, won't go into dealers or who, but that causes a liquidity crisis, right? Because they just can't, they don't have the money or the limits with their banks to buy so much silver that's coming back for refining or whatever purposes, because the prices shot up so quickly. And the person who bought silver at maybe $5 US an ounce now sees $100 an ounce price, and he just wants to liquidate some of his savings to maybe use it in other places as well. Talking on that liquidity, what is your one concern that in a true crisis, banking stress, say currency shock, what happens to liquidity in the physical metals market?
As I said, we had a stress test in the system. At least I'm speaking for North America because I'm not as familiar with Europe and Asia in terms of their localized physical markets. But in North America, because all of our suppliers, wholesalers, the entire supply chain we deal with is predominantly North America. What we saw was, when silver ran from the movement from 90 to 115 US in a very short period of time, brought in a large amount of sellers all at once. You still had buyers. There was a lot of buying going on, but just the ratio of buyers to sellers is usually about 4-1. The ratio flipped to sellers to buyers 3-2. So a pretty significant shift in the activity from the market. Some dealers like us who have clients who are trying to liquidate large positions all at once are calling on their wholesalers, calling on the refineries to help move that metal for the capital required to make the purchases from their clients. And essentially that capital started to dry up. Like you said, people are tapped. There's only so much money in the system. And then what the wholesalers did to react is they dropped their bids by $10 an ounce on silver, which is basically 10% at the time. So what they're saying is, we don't want your silver. We don't want to buy your silver from you guys right now. That lasted about 48 hours before the price dropped to $80 an ounce, which created more buyers. Again, it shifted the ratio back. So to answer your question, when everyone is trying to liquidate at the same time, the supply chain will break. So if you're a smart investor, have an exit strategy, and you may want to think about selling a little bit before the curve. So if you're like, hey, I'm happy at $90 an ounce, 9,500, you may want to liquidate a small percentage of your portfolio.
Okay, and let's reverse this entire scenario. What do you think happens where have you seen moments where demand overwhelms supply, and what implications would that have?
Similar, 2008 financial crisis was that scenario. By about 2010, demand was just massive. And working at Kitco at the time, the only two products we had left in stock were 400-ounce gold bars, which not for everybody, and 1,000-ounce silver bars, also not for everybody, especially when silver had run up to $48 an ounce or whatever it became. So if you have a market where it's only demand and there's not a ton of secondary market product flowing back in, you're going to end up with product shortages. Clients tend to prefer Swiss product, US Mint, Canadian Mint, the Philharmonics, all those mainstream products. Those mints run on very strict allocation and production schedules. When the demand doubles, they cannot keep up with that. And within a matter of weeks, they're going to run out of inventory. And you're going to see inventory dry up. I just want to make clear, some people are saying right now there's going to be a shortage of metal. We've not seen any shortages. Right now, we're seeing a lot of inflow from the secondary market. And like I said, it's actually jamming up the supply chain with inventory. There's plenty of inventory available right now.
Yeah, fair enough. Thanks for sharing the insider's point of view on that. When you touched on that, from your perspective, would you like to break down? Obviously, everyone has a different investment criteria, and I talk to my clients where we go into details of what kind of shape, size, sovereignty would you hold when you're buying precious metals, whether it's gold or silver. Can you just explain quickly the differences between holding a coin compared to an ingot, compared to a bar with premiums, and being able to move it quickly and also liquidating it quickly?
Yeah, so I'll start kind of in reverse. Liquidity is generally equal amongst products. So if you're buying and holding especially if you're holding in storage, for example, you have a relationship with a company like SWP, your liquidity is not going to be a problem whether you're holding an ingot or whether you're holding a coin. There will be a competitive bid based on the general market conditions made for your product. That's one reason more to hold it. If you hold a significant amount of metal, one more reason to hold it within a facility is you have a liquid two-way market, so you can sell your products on a quick basis. General rules for investors who are new to remember is your premium on bars or ingots is going to be lower than coins. So if you're a cost-sensitive person, which I am, personally, when I buy, I tend to look at the premium. I'm trying to save premium or for my clients, I'm going to recommend ingots over coins. Also, the larger the format of the ingot that you're buying, the lower the premiums are going to be as well. It's, in America, they refer to Costco. I'm not sure what the equivalent is where you are in Mumbai, but you have these stores where you can go in and buy it in bulk. It's the same concept when you're buying precious metals. You're going to want to buy it in as large a format or bulk as you can. And ingots do give you that ability where you can buy in 1 ounce, 10 ounce, or 50 gram, 100 gram, kilo. And so the larger you go, generally your premium is going to come down. So you're going to have some cost savings. And last thing investors probably need to know, general rule is gold is going to carry lower premiums than silver. So in terms of portfolio allocations and how that plays out over the long term, I'd say rule of thumb, your split is going to be like 70-30, 80-20 gold, silver. Gold is a pillar in your investment portfolio. Silver is a trade in your investment portfolio generally. Yes, you want to have some silver. Yes, there are amazing industrial applications, solar panels, medical, so on. Silver is very diverse in what it can do for the world, but it's also very volatile, as we've seen.
I call it the widowmaker. And the reason I asked about the liquidity is when you said something about the ingot, there's a differentiating factor. Obviously, again, I'm going to repeat it on this podcast. We're not giving financial advice, but the differentiating factor that I want people to understand is having a sovereign coin, you might pay a slightly slightly more of a premium. But everyone around the world, if in your case you're already holding it, is different. But if somebody is just buying it to keep it under their pillow or in the garage, and then they want to try and sell it, selling a coin is going to be much easier because anyone can recognize it, whether it's a dealer or even the person next door, compared to trying to sell an ingot, especially because the amount of fraud. And I know it happens because I've heard of stories in China where tungsten bars were wrapped around gold plated, and they've actually used as collateral for HSBC bank loans, which kind of turned sour. But anyway, so again, speak to your professionals, speak to somebody who knows what they're talking about. But again, I just wanted to get your view on that. Obviously, if you're going to go for a sovereign or a coin, you pay a slightly higher premium. But the point is, it's more liquid. That's the point that I was trying to get. But as you said, if it's being held by someone like you, it doesn't really matter because they bought it off you and they're selling it back to you. So you're not going to question the gold that they bought off you because you bought it for them. So
We guarantee any products that we sell our clients, we guarantee to buy back. Any products that our clients ship to us from their homes or from their dealer, we'll do non-destructive testing to validate the product, and then we'll also buy that product back. But to your point, in a local market, in your hometown or your home region, your county, wherever, yes, you're right. Coins can be more attractive for the local market. So if you're going to have uh, call it $10,000 worth of gold at home that you store for that worst case scenario, just a few smaller coins, maybe, yeah, you're absolutely right. It's going to be a little bit more liquid than ingots. But if you're buying ingots that are, brand name, Pam Swiss, Valcambi, things like that, you shouldn't have a liquidity issue either, even locally.
yeah, those ones, those well-named ones, which are stamped and sealed, and totally makes sense. What is your view on tokenized? Obviously, everything is moving towards the tokenized and blockchain and stuff. Technology and tokenization. Tokenizing gold. I've actually interviewed someone who holds gold in Swiss vaults, and it is being tokenized. I've interviewed on this channel. Gold and blockchain custody and all of that kind of stuff. What's your view on that?
We've been involved with a number of projects since 2017 in the tokenization space. Some have been incredibly successful. Others have been flops. When I say we've been involved, our role is a service provider. So we're selling the gold or the silver to the tokenization company, and we're providing the storage for the underlying asset that they're selling or reselling to their clients. So we're not tokenizing ourselves. We're not an IT company. We're not interested in that aspect of the business. We've seen, like I said, some successes, some failures. Takeaways generally are that, and this is high level, but you can dive into it if you like. Merging a physical world, physical gold and silver, physical bars and coins, and physical storage with a non-physical digital world can be complex enough that it will drive up the cost of the product. So in theory, if you write a white paper about tokenization, it sounds like a fantastic idea. I love the idea of tokenizing. I remember I was in Switzerland in like 2015 and someone says, we're going to tokenize that lake. It was like Lake Geneva or whatever. Like, we're going to tokenize the lake. And I was like, after a couple of beers, I'm like, this is fantastic. Like, this is so genius. Every citizen of Switzerland will hold the token of Lake Geneva. And what an incredible concept. Well, it's really hard to do things like that, actually, because you have regulations and government, who owns the water rights, the environmentalists, like, didn't happen. But the same is kind of true. The point I'm trying to make is the same is kind of true when you take something physical and you try to digitalize it. It's easy in concept, difficult in practice, which drives up price. And therefore, the company, whomever it may be that is doing this, has to be really solid at what they're doing. Because if they're not, what they end up doing, because they're scared to drive up the price to the consumer, because they compete, basically tokenization products are competing on a tiny little margin. In order to avoid driving up the price to their clients, they start to cheat on the back end. We've seen this firsthand. They'll start to manipulate the position of underlying gold and silver, essentially fractional banking or fractional reserves. So they'll tell their clients, oh, we have 100,000 ounces, really they have 80. And then that number, that ratio just gets worse and worse and worse and worse until the point where the investor is at huge risk. And so you need to understand who owns the company. You need to understand the contract. If there's audits available, great. The fact it's in Switzerland already gives me more confidence than if we're in other jurisdictions, because Switzerland is highly regulated. But yeah, there's been some malpractice, long story short, in our experience.
Yeah, completely agree. Because again, Perthmint also had that tokenized option a couple of years back, and but the person I'd interviewed, his name was Thierry Aris Rouge. I think about around October, November. If any of our audience is interested in that interview, this company is called AGAU, where they actually hold a gram. So when it is not for normal people right now, so it is not for the average citizen. It's only for companies with balance sheets or doing import and export in a multicultural world. And I interviewed him just before he was going to a summit in Brazil with the BRICS countries doing what they're doing. So they're actually holding their gold, and he's working also with certain central banks on certain things. And he's not a big fan of governments and CBDCs and all that kind of stuff. I can outright say that. But it is gold being held in private Swiss vaults for companies to transact with the token. And it doesn't matter what the price is, it has nothing to do with the dollar price of it. One token is 1 gram of gold, and I think one token was 1 gram of silver. And based on that, and as he said, it's not for personal people right now, but he assumes down the track it would come into effect, especially as I don't know, but I don't know what your view is, but with Michael Saylor in the US with Bitcoin and all of that stuff, getting it on his balance sheet, and everyone just saw his share price started going up. So other CFOs started copying that tactic, and now we're seeing what's happening with the Bitcoin price. But I've spoken to a few boards where I've said, why couldn't we do that with holding gold on your balance sheets? Because I would do that, because if I have, again, I have a consulting business, but holding gold on your balance sheets, even if it's a 10%, as we said, as an allocation, because you're de-risking, and again, it's an asset allocation strategy. I won't go into too much detail, but what are your thoughts on that? Do you think companies might start doing that and holding it offshore?
I know some companies are already doing that. I mean, it's not uncommon for a company to hold gold and silver as part of their treasury. Traditionally, most companies that are holding cash positions are investing in US treasuries or other highly liquid, high quality debt instruments. But in this market in particular, and where all the things we've talked about in this interview, if your CFO is looking at all these factors and possibilities and risks in the market, holding 10% in gold is a smart investment. We do. I mean, SWP is part of our treasury. We hold physical gold. I mean, we're in the gold business. I mean, we sell it for a living. We're already hedged essentially, but this was just a self-insurance policy essentially for us. So we do, and a number of our clients who own businesses also use it as part of their treasury. So I wouldn't be surprised if it became more popular in the coming years. Hopefully it does.
Thanks for that, Mark. So just kind of coming towards the closure of this interview, someone's network is largely in the traditional financial system. Let's say your funds, your managed funds, your banks, your pensions. What would be one tip you might just say? What is the one risk that they might be underestimating? What could play out?
I'll speak from personal experience. Uh, you wanted a story. My partners and I, personally, not for the company, I just want to make that clear. This was not an investment. The company made on in a personal level, in our personal lives, we have a small group of friends that invest, and we trade information like, hey, I heard of this great fund, we should go in. So we got into two funds actually, managed through a company here in the Cayman Islands, a local broker who was selling funds, and one of them was sports betting in Europe. So they were basically the logic was they're betting on British Premier League soccer games, and they have algorithms that can predict outcomes and make basically an arbitrage on the outcome of games. And they had a great track record. It was running for 10 years, 20% per year, easy. And so first year we're in, 19% up. Second year we're in, not so good. And then all of a sudden we get a notice from the fund manager being like, the bookie for the betting that was actually taking place has disappeared. He's no longer in England. He's now in Turkey. Then he was no longer in Turkey, and the money had been seized by the Turkish authorities, and now he's in the Philippines. So that was one fund. And then another fund was, so we, lessons learned. It's like you need to do your due diligence. Don't just look at the return. There are always risks with counterparties. This seemed really solid. This firm was very well known, and none of us in the group, are all pretty savvy guys, had even thought could happen. So do your due diligence. Know that there's always risk, no matter how large or the brand name associated to a fund may be. I've seen it in Canada with funds associated to oil and gas. You would never assume this is going to be a problem, and people get wiped out because the funds are mismanaged. So just because you're in a regulated fund doesn't mean it's a perfect case scenario. So again, when you talk about counterparty risk versus real assets that are personal property, where you remove all those things, another lesson learned.
Yeah, thanks for sharing that personal experience. I think a lot of people who've been in the financial industry have learned their own little mini lessons along the way, which has made them wiser, obviously, as well. Because we're in the gold and silver space, just a couple of few ending questions. Do you think gold is being, just an honest question from where you said, right? What are you thinking? Do you think gold is currently being priced for inflation, or total no confidence in the monetary system, the way this is playing out?
Both. Debt, inflation, weakening US dollar, all big factors. Macro political shifts are priced in. That's the thing about this market that's so powerful, is that typically when you do an interview or you look at the market, you can really focus on one thing that's happening. And you could say this one event, the war breaks out in Russia. Okay, that's going to drive up the price. COVID, one singular event. I mean, it affected all of us in different ways, but still one event. Now it's like just from all angles. You can go down the list of things that are happening in the world, and all of them point towards gold and silver pricing better. That won't go on forever. Just, we all know that. Like, you should know that. Everyone that's watching this should know that this is a market. It's cyclical like all other markets, and there will be a point in time where it flattens out, and it's going to be a slow burn for 5 or 10 years. But right now we are in a period of time where there's just so many factors and volatility and risk in the market in general that it's a very good time to have metal.
Perfectly said. And that is why I don't ask people on this show, what do you think the gold price should do? Because obviously it's just clickbaity, and it depends on your currency. If you're in Venezuela, it could be in millions or stuff like that, right? But when do you, so you mentioned something in there, and that's why I'm asking you this question. So when would you offload some of your metal? Because of course, some people might hold it for generations and pass it on to their children. Some people might offload a little bit. So it's not about that, but when do you think about offloading some of your metals?
Such a good question. So it's not, the correct answer is not a price. The correct answer, my mentor taught me this, and I'll try to explain it as simply as possible. Your job as an investor is to determine what percentage of your portfolio you want to hold in gold and silver. First step, 5, 10, some 20. Statistics prove it should be closer to 20 than 5. Should be like 18. That's the number. So you determine what that number is. Step 2 is determine your investment portfolio gross amount. Okay, I have $1 million, I have $100,000, I have $10,000, and you allocate that 18%. That's your initial, make sure that you've topped up to 18%. As your net wealth increases, you increase that holding to equal 18, remain at 18%. If you suffer a tragic loss, or in my case, I lost money in the sports book industry or fund, I have to adjust my gold holding down. You remove all price and emotional aspects of the transaction. You are literally recalibrating monthly, quarterly, annually, whatever schedule is good for you as an investor. You're just recalibrating all the time. That's all you're doing. That's what my mentor taught me, and I think it is probably the best way to go about it, all in all.
Yeah, perfectly. So the asset allocation percentage is in your portfolio as a whole, and that's what you're adjusting. I've spoken to someone who had bought, let's just say, for example, Bitcoin for 50,000, it doubled, and it was only supposed to be 1% of their portfolio. So instead of lightening up then and bringing it back to 1%, they got greedy and they doubled up and they ended up losing quite a lot. So let's just leave it at that. And this is a good principle. But also for me, what I share sometimes with some of my clients, and again, not personal financial advice because everyone is different, but look at certain ratios, your Dow to gold and stuff like that. So there will come a time when gold will get overpriced, or silver might get overpriced, depending on what it is, and houses might get underpriced. I don't think fiat currency is going to be underpriced because it will be hyperinflated away along with the government debt. But there might be other assets that might get underpriced, and that is when you might want to switch from one to the other and a certain portion of your asset. And again, speak to your financial professional that you normally speak to, so you can get some clear advice on how to go about doing this strategically, right?
Absolutely. I mean, short-term profit taking, people are, especially with gold and silver investors, they're so loyal to metal that they forget that it's okay to take profit and invest in a new house or a new boat or things that you're going to enjoy. Look, like life is not about making money. It's also about living your dreams and doing things that you want to do. And if silver has gone from 5 US to 100 US and you're afraid to sell because you can't think of another thing to do with that money, you hear that a lot with gold and silver. They're like, well, where am I going to put the money? There's so much risk. Okay. Yeah. We've talked about all those things today, but you can cash in and you can have some fun and you can buy undervalued assets. I mean, there's nothing wrong. That's a great investment strategy. I totally agree.
Yeah. And it's not just that, right? I tell people, because most of my clientele is in New Zealand and Australia, they are the same way with their houses, right? People who bought one house back in the 70s or something like that, and now they have 6, 7, 8 houses, and they love their houses and they can't get rid of it. And I'm like, the whole point is you've reached the top. You want to maybe get light on one of those. I'm not saying sell off all of your houses and go live in a tent, but sometimes if you have 8 or 10 houses and you think housing is in a bubble, like hitting its top, and gold was really cheap a couple of years back, you could have sold 2 or 3 houses and possibly move that into gold to have that ride up. Again, it's about diversifying. Everyone's situation will be different, but as you just said, you're not planning to hold it all forever. Yeah. You're just trying to go, which is the smartest asset I should be holding right now, given the times we're in. And obviously, gold and silver at the moment, because of the geopolitical risk. And we know this is like a once in 100-year credit event coming to an end with the end of fiat currencies and maybe ending up with a World War III. It is a good time to hold on to gold because that is a stateless asset and it's nobody else. Nobody else is a counterparty, right? As we've already discussed. Um, Mark, quick questions. The audience would. Is there anything I haven't touched? I did want to bring up one quick thing also. Do you guys do? Because I saw something on your website just yesterday before we were going to do this interview. You now also offer loans. So you've created a credit market where people can use their precious metals which I thought was brilliant because I know there's some place in Singapore who does it, but it's brilliant that you guys have started doing it as well. So do you just want to talk around that program?
Sure. Yeah. It's a sister company to SWP. We call it SWP Capital. Essentially, clients of SWP who hold physical metal with us can use that as collateral to borrow money, cash. Well, not physical cash, but money from SWP Capital. So let's say you had $100,000 of physical metal sitting in SWP's vaults. The vault does have to be the Cayman vault, just to clarify. It's not, we can't do the lending in other vaults, unfortunately, just for regulatory reasons. But if you have $100,000 sitting in the Cayman vault and you can borrow up to 75,000 or 75% of the value of your metal, and then you can use that $75,000 to do whatever you like. You can buy more metal. You can buy, that boat that you've always dreamed of. So, and there's no limit. If you have a million or 10 million, it's the same borrowing ratio of 75% that's available to you. The terms of the loans are 3, 6, 9, and 12 months, but renewable. So if you want to carry that loan forward, we've seen a lot of clients renewing because the underlying metal is appreciating at a faster pace than the interest that they're paying on the loan. So they're like, well, this is free money essentially for us at this point. So yeah, in a nutshell, SWP Capital, great way to unlock your metal, because that is one knock that you'll hear investment professionals say. It's kind of a dead asset. It doesn't pay your interest, doesn't pay you a dividend. Totally true. Therefore, you can activate the equity in your precious metals by taking a loan.
Yeah, great. Thanks for sharing that. Because when I interviewed Rick Rule, I think he's got a license to a bank in the US, and they're trying to also do that with gold and silver. So the brightest minds in the world are starting to think, how do we make this asset a little more productive so people can store it, preserve their wealth, but also use it constructively in the day-to-day living, right? And yeah, so I came across that yesterday. I thought I'll ask you about that. Um, Now it's a chance to you being gracious with your time. Thank you. But the way I end most of these is we ask a few personal questions just for the audience. Only the first time you come on, so the audience gets to know Mark on a personal basis. Um, so, Mark, firstly, when you're having a beer, as you said, with your mates and stuff, what's one book you'd recommend to your friends or family members?
Yeah, I love to read. There's a lot of there's so many good books out there. It's hard to pick one, but if I had to, I'd say Principles by Ray Dalio is excellent. There's also another book, and I forget the author's name. Is Homo sapiens kind of explores us as an animal and why we behave the way we do and why we've evolved how we had. So Principles by Ray Dalio and Homo sapiens, two great books that I recommend.
Sure, I'll put a link as always. Um, Another beer time thing. Any funny story you want to share other than the money that you lost on the betting and stuff? Any funny story you want to share with the audience? Is there much maybe in the gold industry, maybe a funny story or something along those lines?
I was trying to think of a funny gold story. It tends to be a pretty dry business, Farzin, to be honest. Um, Funny, I mean, it's not funny. It's funny to me, but very personal. Recently separated, unfortunately. But n- amicable, totally for the best. Happy to move on with my life. Joined Tinder for the first time as an adult. I'd heard all my friends, over the years talking about Tinder. So here I am, 45 years old, have no idea what I'm doing, don't know how to make a profile, haven't dated in, 20 years. So I end up on Tinder, and the first match I managed to get turned out to be some sort of catfishing, fake name, fake picture, fake employment, and just I was like, wow, is this the world we live in today? So that's my recent story to my friends yesterday at the round of golf we played together. I was telling them about my Tinder experience has not been so good so far. So all that to say, beware, folks. There's a lot of misinformation out there online.
Oh, there is a lot, and it's not just you. I think there's a bit of spiritual and star stuff happening. There's a lot of people who've gone through breakups in the last 2 or 3 months. It's shaken up a lot of stuff, and yeah, happens, right? Bigger and brighter days, too many fish in the sea, as they say. So, as long as it was amicable, you're a handsome looking man, you're running a good business out there, I'm sure there'll be no shortages of women lining up to God. Not the fake ones. Take out the real ones out for dinner dates. Anyways, coming back to this conversation, what was as you said, you're 45 now, but younger on in your career journey as well. What do you think you would say is like the one piece of best advice or somebody, a mentor gave you, or a quote you heard which changed your thinking in life or guided you a certain way?
Hmm. There's a saying that there's two sayings I really enjoy. One is to change is to live. So the question of, or the idea of always improving, always challenging yourself, always pushing yourself, change. You- don't just sit on the couch, get off the couch, do something different, challenge yourself, travel, just evolve as a person, obviously is a big one. And then another one I like a lot is everything is exactly the way it should be all the time. So being present in the moment, accepting where you are right now and knowing that this is the way it's probably intended to be. And there's a lesson, whether it be an unhappy moment, whether it be a joyous moment, is to really, be present and to know it's part of your journey, your evolution. And those are two things I remind myself of on a regular basis.
Yeah, perfectly said, mate. Life is changes life. Yeah, you wake up, there's always sunrise in the morning again. Um, One last question for people who know. Obviously, I run a consultancy called Success Simplified. So, Mark, what does success mean to you? Or how do you define success?
Such a good question. How do you define success? I define my success based on my ability to help people around me be better and for myself to be better. So it's not a monetary thing personally. It's very much about mentorship and self-development. Whether I'm helping people develop or I'm developing myself, that's what I consider success. And generally the financial aspect of that is that it allows you to have the freedom to spend more time doing that. So if you have financial freedom, you can then focus on yourself and focus on other humans around you and not worry about how you're going to pay your bills. That's, I guess, my definition of success.
Perfect, man. Thanks for sharing that. And where can people follow you after this conversation?
Sure. On LinkedIn, Mark Yaxley on LinkedIn. If you want to connect on a personal, professional level, we have a great YouTube channel. You've probably seen it. Inside the Vault is a series where we actually open the vault door. We do all these educational pieces about physical precious metals. A lot of the things that we've talked about today are on that YouTube channel. And yeah, I think we're on Twitter, we're on Facebook, we're on every social media channel that our marketing team can find. So you can find us in a lot.
You have to be on all these social channels nowadays just to be able to do normal business, right? It's kind of funny the times we live in. And obviously, you and I will work out something because you did mention you'd be happy to offer some kind of either a discount or some kind of a waiver to people who do want to connect after listening to this podcast and do want to see what SWP has to offer, right?
Yeah, I spoke to our head of sales yesterday afternoon. He asked me about a few different ideas. I know it'll get finalized probably, hopefully before this goes out, so that your viewers can take advantage of a discount from SWP. Essentially, we love the work that you're doing. You've been a good partner for a while now for SWP. So hopefully that incentivizes some people to take that step and invest more in precious metals.
Yeah, thanks for that. Anything else you want to end this note on, Mark?
No, it's been a great conversation, great questions. Really appreciate it. You're doing good work, obviously, for people. So it's always a pleasure to connect.
If you enjoyed this conversation, make sure you like, share, and subscribe, and possibly even share this with somebody who needs to see this interview to understand a little bit more about the precious metals and what happens on the insides. And as always, stay curious and keep connecting the dots. And if you're interested in the discounts being offered by Strategic Wealth Preservation, please look below in the show notes. There will be a link provided for a limited time discount if you'd like to see how they can help you out in your journey. Thanks for your love and support. Appreciate it.